Rajat Rajgarhia of Motilal Oswal joins in as well to talk about the market. Hi Rajat, morning. Before we get talking about the market, where are you guys placed on Reliance right now, and what kind of price or earnings target do you have on that?
Hi, good morning. As far as Reliance is concerned, we think we're going to see some range-bound moves for the stock right now, because a lot of the negative news, while has got factored into the stock, at least there still lacks any near-term catalyst. It's going to be more of a stable business right now, where the refining margins will more or less average at around $9 to $10. Petchem is stable, and E&P is probably more or less bottomed out at 45-46 MMSCD. I think more important is now what kind of news flows you see coming out of the deal that they have done with BP, whether it helps them to further start ramping up their production. So I think more or less you will see the stock tracking, and till the time you don't have clarity on markets on whether they have any catalyst to move up in the near term, Reliance being such a big important weight into the markets will continue to track the markets.
Given how much you brought down earnings expectations for the full year, Rajat, at the end of this earnings season, which sectors would you like to get out of in this pullback rally that the market's witnessing?
Well, right now, if you look at the earnings momentum, the 2 or 3 spaces which have seen more resilient in their earnings, one has been telecom, where actually earnings have seen upgrades. Second has been two-wheelers, and third to some extent has been consumer. I think 2 or 3 spaces where investors would like to reduce their bets first would still be utilities, because there still exist problems on how a lot of these power projects which are supposed to get commission will get commission, and what kind of profitability will happen. Okay, that's one space. Second, I think some of the global plays will still continue to remain uncertain right now, because you continue to see news flows on both positive and negative, more negative than positive right now. So you will see bounce backs happening into stocks. But for example, there are some sectors which have got seriously impacted, both because of global headwinds and because of some domestic developments. For example, like JSW Steel, where you are now seeing them operating at lower utilization levels. So whenever you see bounce backs happening in the stocks, these could be the ones where you can start seeing some reducing exposure by investors.
Okay. What's your sense, Rajat, of what could be fair value for the market now, given where earnings expectations stand for the Sensex? Do you think there's more downside based on your fair value calculations?
Well, if you look at the earnings right now, they stand at closer to 1150, and at the current levels, markets are trading at 14.5 times, which is just about the long-term averages. But the more important point is that the alternate investment option, which is the debt, today yields you almost 10%, and in some cases 11% also. Till the time you have the debt yielding 10% kind of a return, I think 14.5 times will not look so attractive from a market's point of view. So the market at the aggregate level may have to drift down, or the debt returns have to come down for these multiples to look attractive. But I think the other side of the story is that while the market today trades at 14.5 times, you have few stocks in the index which trade at 20 times, which is pulling up this multiple. Otherwise, a lot of the investable universe today trades well below their long-term averages. So the markets have got really fragmented now, wherein on one side specific stocks are pulling up the entire averages, but a large part of the investable universe has now trended below their long-term averages. So rather than taking an aggregate market call, I think individual sectors and stocks have started looking more attractive right now for investors to get in.
What's the call on 2 stocks, Rajat, in that case, SPI and L&T?
Well, definitely more positive on SBI than L&T right now. More because, look, SBI multiples typically always have some cyclicality with the interest rate behavior. We saw the stock trading up to more than 2 times book just 7 to 8 months back. From there, it has now come down to 1.1, 1.2 times book. The good thing about these banks is that their book just keeps on getting higher and higher every year. So even if you don't get any return for another 3 months, the book will become higher, after 12 months, and then in that particular you may suddenly get an extraordinary return. L&T, coming to one of the earlier questions that you had asked, which sectors that we would still avoid. I think capital good as a space is something where we would still avoid making any higher allocation, because if you were to start seeing the domestic activity picking up into the system, you would first have some of the very beaten down names like financial specific autos, which will bounce first. Okay, in categories in capital goods, even in L&T, I think you will get chance before you were to start making higher allocation. Valuation still trades fairly well for most of these capital good companies, and I think we are yet to see, or we are going to see some more downgrades happening into these names over the next 2 quarters. So SBI definitely a very good price to start buying. L&T, one can just wait to get more clarity. I don't think one will miss out too much if you don't have an over allocation to capital goods for another quarter or so.
Rajat, how are you approaching, or what are you telling your investors to do with ONGC leading up to the FPO, which should be launched sometime in the next couple of weeks?
Well, I think there seems to be a consensus building on that the FPO pricing will be quite attractive. We have seen the last 3 or 4 divestments where we have been surprised by the extent of discount which has been offered into the FPO prices of the stocks. And the same hope, given that the size of ONGC is quite large, people think that it should be at a good discount to the current prices. So most of the investors think that they will get a good share of allocation, given that it will be a big issue. The global investing environment is not so positive right now, so you are unlikely to see big subscription coming from global investors. And more importantly, while price is one thing, I think people have been disturbed every quarter now, or should we say every year, by the very irrational sharing that we have seen on the subsidy side. So we have seen a lot of comments coming on your channel itself, where there has been comfort in terms of the 1/3 subsidy sharing, but then this sharing suddenly got changed in the 4th quarter of last year. There is no guarantee that this subsidy sharing will hold on. Given that the subsidy losses itself is mounting at 112, 113 Brent, there's almost more than 1 lakh crore of subsidy which runs into the system. So I think just because that the price is going to be at a good discount to the current price, you will see a good response coming from investors.